Okay, we're going to get started now. Just got to start the recording. It looks like the recording already started, so we're good to go. My name is Joe Ely, and this is the Lightspeed free webinar, Trading Credit Spreads and Iron Condors in a Volatile Market. This presentation is by Dan Sheridan. Dan Sheridan is the founder and CEO of Sheridan's Options Mentoring. He has over 25 years of experience trading options and educating traders worldwide. So here is our disclaimer that we have to read in order to continue. This presentation is for informational purposes only. Nothing presented today should be construed as investment advice or a recommendation to buy, sell, or hold any security or contract. Since we don't know everyone's investment objectives or risk tolerance, we are not endorsing any specific trading strategies. Security, derivative, and futures trading involves the substantial risk of loss and is not suitable for all investors. Each investor must consider whether this is a suitable investment, since you may lose all or more than your initial investment. Past performance is not indicative of future results. Lightspeed is a division of Lime Brokerage LLC. Lime Brokerage LLC is not affiliated with these third-party market commentators, educators, or service providers. Data, information, and material are provided for informational and educational purposes only. This content neither is nor should be construed as an offer, solicitation, or recommendation to buy, sell any securities or contracts. Any investment decisions made by the user through the use of such content is solely based on the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Lime Brokerage LLC does not endorse, offer, nor recommend any of the services or commentary provided by any of the market commentators, educators, or service providers, and any information used to execute any trading strategies are solely based on the independent analysis of the user. That was a mouthful. So given that, I'm going to move on and turn the presentation over to Dan Sheridan. Dan's going to bring up his slides, and we'll move forward. There we go. We can see your slide now, so I think we're good.
All right. Thanks, Joe. Thanks, everybody. Welcome to Trading Credit Spreads and Iron Condors in a Volatile Market. And let's jump in here. Okay, so let's start out before we jump into some credit spread and Iron Condors example and start talking about these strategies. Let me give a little perspective where some of these strategies fit in. You know, when you start trading, what do? Do you read a book, and the first strategy you read, you put it on? How do you determine which strategy you do? So I'm trying to give you in this slide here a little bit of 30,000 feet up in the airplane, a little perspective on how, when I'm setting up an options portfolio, where does everything fit, right? And hopefully, whatever you guys do, whatever strategy you do, somewhere it's going to fit here. And I'm trying to just make a little structure, because you should be running, somebody should be running an options portfolio like a business, period. It shouldn't be winging it or gambling or, hey, I read about this strategy and I'll try it. And no, there should be structure. So first of all, we have 3 buckets of an options portfolio. Now, doesn't mean you're going to trade each of these buckets, but this is where, to me, everything fits in and where we get some structure. So long portfolio strategies would be taking the perspective of a individual investor in your retirement account where, hey, I like the market over time. You're neutral to bullish on the market over time, right? That's how your philosophy is in a retirement account. So these are going to be more an intentional. Every month, I'm intentionally putting on some of these strategies, long portfolio, and they're basically neutral to bullish. A covered right strategy, buying stock and selling an out of the money call. Cash secured put, selling a put with the idea that if it goes down, you get assigned on the put, you buy the stock. These are all bullish strategies. Short puts, put credit spreads, or vertical spreads, which we'll talk a little bit about today. Long diagonals, which would be, instead of buying stock in a covered right, buying in the money option instead of the stock, and selling out of the money call. Buying stock, buying a leap option or in the money option, buying an ETF like SPY, or I just put broken wing butterflies. Some of those strategies are more neutral to bullish, but the first bucket is long portfolio. And I'll, as I go over a couple strategies today, I'll tell you where they fit in. But I believe you should have some of your allocation for options dollars in the long portfolio. And that's an intentional thing, right? Versus, let me flip to the other side. Let's skip income for a second. Speculative part of the portfolio would be your philosophy is you wake up in the morning and what do you say? I have an opinion, right? I have an opinion. You know, your opinion could be based on technicals, fundamentals. Maybe you had a pizza at 2 a.m. and you wake up with a revelation. It could be based on you saw something in the news. But speculative is versus the long portfolio, which is similar to your retirement portfolio, where you're putting an X amount a month intentionally in long positions. Speculative portfolio, you may think the market's going down, you may think it's going up, you may think a stock is going down, you may think it's going up. And so speculative portfolio, these are some of the strategies I would use in the speculative part of portfolio. Credit spreads, I would say that's directional. If I think the market's going down or I don't think it's going to go up too much, I do a call credit spread. If I think the market's going up or I don't think it's going down too far, do a put credit spread. But there's I have an opinion versus doing a put credit spread in the long portfolio is I'm taking this intentional bullish position every month like a retirement account. So speculative portfolio, credit spreads, buying options, buy calls or puts, buying vertical spreads, these are different strategies. And I'm not going to focus on what they all are, long strangles or straddles, back spreads, reverse calendars, directional butterflies and calendars. But those are more strategies where I have an opinion. And then the last part of the portfolio would be income portfolio. So today, when I'm talking about credit spreads, I'm going to talk about an example of a credit spread in SPX and that would be based on, and we'll do that with Joe in a little bit. The second half of this webinar, Joe and I are going to go over 2, 3, 4 different types of credit spreads as examples, what I would do in the market right now. And so some of them would be from these different parts of the portfolio, and I'll illustrate that as we go on. An example with SPX near 28.10, it closed at today. For those of you watching the market, would it be fair to say that we've been bumping off that 28.10, 28.13 area for a good week or two? Agree? That it seems like some resistance around that area. So if you thought, hey, opinion, hey, I think that resistance can hold and we can go back down, hey, I'll do a call credit spread. That would be in the speculative part of the portfolio. But in the long portfolio, I still could be doing a put credit spread saying, hey, we're above the 200-day moving average at 27, is it 50? Something like that, the 200-day moving average. Intentionally, I want to put on a put credit spread every month in the SPX. If it goes lower, I'll do it again. But let's say every month I put it on or every 2 weeks. That's an intentional bullish position. Income portfolio, we're going to talk about iron condors today. Iron condors, butterflies, calendars, double diagonals. The philosophy there is range-bound trades where my edge is probabilities and decay. And I put those on on a regular basis. So income portfolio and long portfolio, I'm putting them on consistently every week or month. Speculative portfolio, I'm just putting them on when I have an opinion. So again, that's a structure. My guess is everything you guys do would fit in that portfolio, and I'm just trying to structure it like a business. Any questions on that slide? Any questions on that slide, or if you have a strategy that does not fit in that? But that's how I look at it. And based on the VIX and SPX levels of the market, I may shift a little bit of allocation from one end to the other. For example, in January and the end of December, with VIX very high, 25 or whatever, in the SPX down 20%, near 2350, 2400, at that point, we upped our allocation in the long portfolio versus the other parts of the portfolio. Why? Because the market was down a lot. And if you're bullish long term, you should be more bullish when things are down 20%. Agree? And so right now in the current market, with us up almost 450 points over the last 2.5 months or so, we've gone from maybe 50 to 60% of an options portfolio being in a long portfolio to maybe 20 or 30%, just because we've run up a lot and I'd want less exposure. So anyways, just giving you a little bit there. I just put this here, sample 50K options portfolio. Again, big picture perspective before we jump into strategies. With SPX at 2803 and VIX at 13, we're somewhere around there today. Long portfolio strategies and a $50,000 portfolio. I might put 30% in there, 50% in income portfolios right now, 10% in spec, 10% in cash. Again, doesn't have to be exact. Some people may not trade. They might just trade income portfolio. But again, we're trying to run this like a business, right? Not like a crapshoot. Each strategy and part of the portfolio should be a standalone profit center, just like different divisions at a company. You know, if I'm doing iron condors, my goal isn't just to try one iron condor, see if it works. That's not a craft, right? My idea is once you learn a strategy, I want to do an iron condor every week or every 2 weeks or every month, consistently, intentionally, to try to bring in $2,000, $3,000 a month. It's a profit center, and that's how I think you should approach trading. Market conditions right now, we closed at 2810 to be exact. I put 2803. Would you say we're channeling or trending in the market right now? Would you guys say we're channeling or trending? What would you say? Any opinion? Channeling or trending? You could type in. Would you think we're channeling or trending? One says channeling, some trending. Yeah, both. It's like we have some channeling, so time frame would be like now, over the last month or two. We've been more channeling, right? From September, what about September to Christmas Eve, September 2018 to Christmas Eve, we've gone down 20% in SPX. And from Christmas Eve to now, we've gone one way up, like a big V, about 18%, right? So the fact that we've been up a lot since Christmas Eve isn't as big a surprise when you consider what happened before that from September to Christmas Eve. We're up 20%, right? So I would say we're more channeling right now. But anyways, I just put ATR there. ATR is something we look at. It just, ATR is average true range, and it looks at the high and the low of the day. And it gives you an indicator, basically, when you're looking at a price chart, how big the candles are. When the candles are bigger, it says there's more movement in, let's say, SPX or RUT or whatever product you're looking at. So we generally look at, if we're looking like an 8-day ATR, some shorter term, when the ATR is under 25 or 26, we look at it's fine to do iron condors. When the VIX goes over 18 and ATR goes over 25 or 26, we lighten up on iron condors. Hey, Dan, why? Why do you lighten up on iron condors? Because to me, there's an environment for iron condors, which is a range-bound strategy, where it's comfortable. It's like in Chicago. I live in Chicago, and there's weather conditions where I'm comfortable driving. But once you get icy and over 12 inches of snow, we change a little bit, right? So when the VIX goes over 18, what does that mean? It means the market's dropping like a rock, right? And volatility is going up. Both of those aren't really good for iron condors. You say, well, Dan, don't you like when volatility's high? I like when volatility's high, but when things are a little more under control. And you know, if you look at like October 10th, when the market started breaking down, things got pretty crazy. So it's like, when do I want to play, right? When do you want to play baseball outside? Okay, I don't want lightning. I don't want heavy rain. And I think that's what we try to find for these. When we'll play and when we'll go back on the sidelines. As Kenny Rogers says, know when to hold them, know when to fold them, right? I think he said that. Now, let's move on. So I just put this here. If you're ever looking at stocks, right? If you're looking at stocks to consider, I took this from the CBOE. If you just Google Equity Archive Option Volume, this is a list and order of the most liquid stocks that traded in January, as of January 19, so the latest month. And so you could see Apple's number one, BAC, AMD. These are your 100 most liquid stocks in order. So, and that's important. If I'm going to trade credit spreads and stocks, for me, I need a high enough price to get a little bit of premium, so at least over $100, and I want it liquid. So here's just a list for you. All right, so the first credit spread that we go over here, we'll go over this kind of quick. I want to get in here and look at some spreads in the platform with Joe. But here's a couple different ways of looking at credit spreads. How many of you do cash secured puts? Anybody do cash secured puts? What's a cash secured put? I sell a put, stock's at 100. I sell a 95 put for $2. If the stock doesn't go down, I collect the $2. If it goes under 95, I buy the stock at 95 less the premium. It's basically very similar to a covered right. And a lot of people, Warren Buffett did this, has done this for years. Michael Dell did this in Dell Compute. You know, a lot of people, it's an easy strategy. So what I'm bringing up here's a proposal of, I wouldn't do a cash secured put. You say, Dan, why wouldn't you? You know, even if you have the money in your account to buy the stock, that's all good. I'm not saying it's bad, but I'm just saying, would everybody agree that when you buy a stock costs a lot of money, right? And so I'm just giving you an alternative to a cash secured put alternative, and I'm using Costco. Costco's been on a tear lately. Agree? I like Costco. I go there a couple times a week. My wife, get the same items. I can be in and out of there in about 7.5 minutes. I don't know if any of you can beat my record. But here's an example of Costco at $2.19. I took this maybe in the last week. Costco's higher, I think. Sell one April 5. I think Costco's at $2.36. I did this a little over a week ago. Sell one April 5, $2.05. Put at $2.20. Buy one April 5 put, 195 strike at 89 cents for $1.31 credit. So in this example, I'm selling the 205 put, which is about $14 out of the money. This was an example about a week and a half ago. The stock's higher. So I'm selling a put, and I'm picking my strike based on the delta. Delta of 20 just means there's only a 20% probability that we're going to finish through the short strike in 34 days. This is the April 5 expiration as of this date. And so remember, if you're doing this type of strategy, a cash secured put alternative, which is just a put credit spread, what's the basis? I like the stock. I like Costco over time. right? And if I like it over time, like an investor, I can do something out of the long portfolio. I could buy stock that costs a lot of money. I could do a long diagonal. I could do a put credit spread. I can do a cash secured put. I like a put credit spread because it's a lot less capital than a cash secured put, and the yield's higher. So again, I pick a short strike out of the money to get some probabilities in my favor that we won't go that far, but I don't want to go too far out of the money that I don't get anything. So here's how I usually do it, folks. I look for a delta around 20 on the put. That gets me far enough out of the money it'll probably expire worthless. And then I'm going to buy a put against it anywhere from 20 to 30% of the value of the short put. So if I sell a put for, in this case, $2.20, let's say 220 times 25% would be 55 cents. Look for a put at 55. I looked for a put. I took a put 89 cents here, right? Again, you say, Dan, why didn't you buy a put at 55 cents instead of 89? Well, there's two sides of every coin, right? If I would have bought a put at 55 cents, this spread would have been, instead of 10 wide, selling the 205 strike, buying the 195, I might have had to buy the 190 puts. You say, what's the problem there? It'd be more capital and a higher yield. So, but anyways, whatever price you sell the put, let's give a window of 10 to 15% to 30% of the value of the short put, buy a put. All right. So in this case, I sell it for $1.31 credit. Your margin is the difference in the strikes. 205 minus 195 is $10,000, less the credit, $131, is margin of $869. Right. So if you look at this thing here, let me bring up the annotation. If you look at, this is the price of the underlying. The green line is the expiration graph. The purple line is the graph when you put it on. So as you see, this green line, so we make money between 205 all the way up, and definitely on the upside. So this green line is about a 15% yield at expiration, which is going to be a lot higher than a covered right, potentially, or a cash secured put, because you eat up a lot of stock. Or you eat up a lot of cost on the stock. Your Greeks are your 10 deltas long. For doing this spread one time, the delta of the short put is 20. The delta of the long put is 9. 20 from 9 is 11. And the one you're selling is since you sell a put that's long deltas, so about a 10 or 11 deltas long for each one. Positive theta trade, because the one you're selling is going to decay quicker than the one you're buying. It's a bigger number. And it's short vega. That means if the volatility of your short and long both went down $1, it makes a little over $7. If it went up $1, you'd lose $7. So that's using a put credit spread as an alternative to a cash secured put. And at basic risk management, if the setup here is selling a 20 delta, 10 wide spread, and I would do this in Costco or a stock I like, every 30, 35 days until I'm 93.5, or my opinion on Costco changes. But if in your retirement account you buy 100 shares of Costco and leave it there the next 10 years, I would surely do this. This has a lot less risk on the downside than owning stock. Now, a simple risk management plan, since we don't have a lot of time here, and I probably won't finish all my strategies just because I want to jump in with Joe in a little bit. But just to give you I usually have a 4-step risk management plan on every trade I do. Number 1 is the setup. Number 2 is the profit target or max loss. Number 3, when to adjust. Number 4, how to adjust. But for most beginners, and if you're getting your feet wet with these strategies, forget about when to adjust and how you adjust. Think about the risk management system here that I've patterned after one of my famous friends, the Karate Kid. Wax on, wax off, right? Put it on, take it off. So in other words, if I'm doing this for $1.31 credit and the capital for one contract is $8.69, my potential yield is 15, I might say, hey, I'm going to try to make, I usually like to stay in, if this is a 30 or whatever the trade is, I like to stay in it generally about 30% of the time is my goal. So if it's 30 days, maybe 9 days, 9 or 10 days. So how do I do that? I'm looking to make maybe about 7%. 7%, it's not your credit, it's what the capital in the position. So 869 times, let's say 7% would be about $60, right? So 7% is $60 for every one contract. My profit target would be, let's round this to $1.30. I can do easier math on that. I'd be trying to buy this back for 70 cents debit. If I can buy this 131 credit back at 70 cents debit, I'd make about $60 divided by this or 7%. And my goal is to do that in about 9 days. Now, what if it goes against me? That's profit. How about a max loss? What if it goes against me? What do I do? I don't want to lose. Just giving you just some risk management that makes sense. There's a lot of ways to do these. If I'm looking to make 7% or about $60 for every one, I don't want to lose more than 1.5 times what I'm making. So if I'm looking to make $60 or 7% on each one, I don't want to lose more than $90. So that means if I sell it for a 130 credit, I'd have an order in to buy it back at $2.20 debit. If it hits 220 and I sold it for 130, as Roberto Duran said to Sugar Ray Leonard many years ago, no mas, I'm done. Dan, how did you get that? Again, I'm trying to make 7% of my margin, right? It'd be about $60 in this particular case. And I don't want to lose more than 1.5 times what my profit target is. So if I'm trying to make $60, 1.5 times that is 90. I sold it at basically 130. If I buy it back at 220, that means I'd lose $90, right? 90 divided by 869, it's about 10%, right? So I don't want to lose more than 10%, which is $90. A very simple plan. I didn't get into adjustments and everything. But again, the biggest problem people run in with credit spreads is this. They'll win, big move, and they'll just lose it all. So anyways, those are some thoughts. Let me move on. Let me just go with maybe one more, and then we'll jump in with Joe, and we'll so I put this 4-step risk management plan, which we talked a little bit about. Let me get rid of the annotation here. Okay. So here's an example. Let's just do this, and then we'll bring Joe on. So we're going to talk about an income. So this would be in the income portfolio. I'm basically looking for range-bound trades, and my edge is probabilities and decay. And I'm going to put something like this on. This is just an example of a 20-day iron condor. And because there's so many different expirations these days, I can put a 20-day iron condor. I might put one on every week, right? Every Wednesday. Or if you're busy on Wednesdays, do it on Thursdays. I don't normally put trades on Friday, Monday through Thursday. I generally put it on. But here's an example of how I would do an iron condor. Here's an example. And again, I took this from March 2nd, about a week ago. But stocks at 2803. And when I'm doing short term, and I'd consider 20 days kind of short term, I want to get my position deltas relatively close to zero. That's about one delta, within 1 or 2 deltas. So in this case, I sold a 10 delta, which would be the 2820 call and the March 22 expiration. This is about 77 points out of the money from where SPX was at the time. On the put side, I sold the 2710 puts. That's a 16 delta. And the 2710 puts were almost 100 points out of the money. Right? And this, again, this is the graph at expiration. That would be in 20 days when I was putting it on. That's the graph I put it on. We'll call that like a T+0 graph. Now, this is an iron condor. It's a call credit spread, selling the call here, buying a higher strike call. That's called a call credit spread. On the downside, selling the 2710 puts, buying the 2700 puts. The total credit, $1.75. The distance in the strikes is 10, so we have $1,000 of risk, less the credit, $825. So your potential expiration yield would be, at expiration in 20 days, would be $175 divided by 8.25, would be about 21%, would be this graph here at expiration, potential. And your Greeks, your positive theta, because your short options, again, the foundation of a iron condor is a short strangle, selling an out of the money call and put. And I don't normally do that, just selling the out of money call and put, because it just costs too much capital. So you buy your hedges against it, in this case, 10 points away. And again, keeping the same thought process, folks. If we're doing a plan here, it's a positive theta trade because your short options are going to decay quicker than your long options. So you get some positive time decay every day. Try to keep my position deltas closer to zero. I want to make my money on theta over time. And this purple line will morph into my expiration line as we keep adding days into the future. Now, similar to the credit spread, if my margin is 8.25, I may try to make 7%, right? 8.25, and again, I may look to be in this trade probably around 6 to 8 days, 30 to 40% of the time of the duration. So if my margin is 8.25, I'm just giving you a basic plan that we're going to run with Joe here. 8.25 times 7% would be almost $60, right? So for your profit, if I'm trying to make almost $60, I'd have an order in to buy back this 175 credit at $1.15 debit. So if I sell it for $1.75 credit and it goes to $1.15 debit, I'd make the difference, right? About $60. 60 divided by my margin of 8.25, mean I'd make about 7% over the 6 to 8 days in this trade. Max loss, again, pretty similar. If I'm looking to make about 7%, I don't want to lose more than 10%. All right, so my max loss, I don't want to lose more than 10%. 10% of 8.25 is about $82. Let's call it $85. Right, so if I sell it at $1.75 and we go up to we're selling it for $1.75 credit. If that $1.75 credit goes up to like $2.60, right? That means we've lost about $85. We sell it at $1.75, buy it back at $2.60. That means we'd lose about $85. 85 divided by 8.25, this is just one contract, would be about 10%. So the bottom line is when you do these income portfolio iron condors, and you're selling, you're out of the money call and you have the probabilities in your favor, but the most important thing is, can you keep your losers not far from your winners? Because you're going to win a lot more than you lose generally. And it's the discipline of managing this when it goes against you. And these iron condors, when the VIX is under 18, we play. Probably between maybe a 12 and 18 VIX, we play. If it gets too cheap, under 12, I'll do like an iron condor alternative, which would be like a double diagonal or a double calendar, similar type graphs. But when it's between 12 and 18, we plant our seeds. We're in, we're in, we're in, we're in, we're in. And we're going from there. So that's just a quick little capsule of this. Let's bring Joe in here and let's look at the platform and look at some different examples of credit spreads and iron condors.
All right, thanks, Dan. So what I'm going to do now is transfer over the screen to my desktop and pull up the Lightspeed Trader platform. Dan, I highly enjoyed your presentation. It was fantastic.
Oh, thanks. So, folks, as Joe is bringing up the platform, let me just make some comment. A lot of the things I was talking about, the most important things, and I think being a successful credit spread trader or an iron condor trader are intentionality and keeping your losses under control. And those two things have absolutely nothing to do with your knowledge of options. That's called discipline, and it's also called discipline, right? So the most important things in these two strategies are the intentionality, doing it on a regular basis, and having a plan to get out of your losers. Let me just say this. If I'm down at my max loss on an iron condor, do I usually take off the entire iron condor? I don't. I just take off the bad side because we usually move too far away from the good side, and it'd be easier execution that way. So when I'm getting out for a loss, I'll just take generally, that's another discussion, but just the bad side. So if we go down, I'm taking off the put side. If we go up, the call side. All right, Joe, why don't you let everybody see the software? That's great.
Yeah, so I pulled up the Lightspeed platform. Can everyone see it? If you could just type in yes or no in the questions, I'd appreciate that. All right, thank you, Lorenzo. So this is a very basic one monitor setup. I have everything linked together. We're looking at Microsoft here. We have a stock level 2, stock order entry, a couple of charts, watch list. We have an options level 2 with a single leg option order entry at the bottom. We have our orders window, positions. Here's a chain, an options chain for Microsoft. You have your calls on the left, your puts on the right. In the upper right-hand corner, we have our complex options order entry form. There's just a couple of random options in there. We'll take those out. Maybe Dan can give us a couple of options to put in there, and we can take a look at what it looks like on the platform. But this is the basic setup if you're gonna trade options on the Lightspeed Trader platform. And what's really nice about the platform is everything is linked together. So you can set it up. I double click on my watch list on GM, and it updates all my windows. This is the options level 2. You would click on the drop down and choose a strike, expiration and strike. There's an expiration. Here's the strike. And then you get the level 2, the depth of book for that particular options contract. The order entry at the bottom is just a simple, if you're just buying a straight put or call, this is where you would enter it. The option chain in the center, you can, pull up, all options, just the standard options if that's what you want. You can have it set to default to, all prices, near money. Same thing with the date. And it's built so that everything is very simple and easy to use. Dan, do you have a couple of option contracts that we could throw in this order entry?
Yeah, what I like about this is the fact that it's all basically on one screen. You don't need I mean, it's kind of neat, and it doesn't look that busy. So I mean, you can do. So let's look at it. How about this? Let's look at an SPX call credit spread. Is that okay?
Sure.
Yeah. So folks,
Whoops.
and
I
we'll
don't
look.
even know what. Let's see. SPX. I don't even know what the symbol is for
Yeah.
SPX on the platform. Let's see. Because it's an index. No, that didn't
Oh
work
yeah.
either. But go
SE.
ahead. Go ahead. I'll find the.
Should I use a different one? Oh yeah.
Yeah. If it's a
So
regular stock, it'd be easier.
yeah. Okay. Let's do. Let's see. Well, we could do Amazon.
All right. So I typed
Well,
in
you know what?
Amazon.
We could look at. Yeah, we could look at Amazon. I was looking at Iron Condor. Should I start with maybe just a credit spread, 2 legs, make it easy?
Yeah, that's easy. Yeah.
Let's look at Costco, because I was talking about Costco, COST, and that's been on a tear, Joe. It's at, I think today, Costco is $236,
Yeah.
up 3. I mean, Costco has been one of the strongest stocks in the market, and I don't know, Joe. Do you ever go into Costco?
Yeah, of
I
course.
go there all the time. Yeah, I didn't realize this is interesting. My brother-in-law was over for dinner a couple of weeks ago. He just retired Chicago fireman, and I said, "Where are you guys going with the kids, teenagers, for spring break?" He goes, "Oh, we're going to Mexico." But where'd you buy it from? Costco. I thought he was joking. I didn't know you can do that. He goes, "No, we bought the whole Mexico trip from Costco, and it's amazing. And every time we go in there, it's busy, and what a company." But anyways, so let's look at Costco, and let's say again, this would be a long portfolio strategy. Let's say we're intentionally, if you would buy 100 shares of stock in Costco and keep it for the next 3-4 years, then every month you might consider doing a cash secured put alternative. And so let's look at the April 12 expiration, Joe. So I'm looking at 30 days out, folks. This would be every month I do a put credit spread and look to sell maybe a 2026 delta. So here'd be the example. In the April 12 expiration, which is 30 days out, I'm looking to sell 1 230 put and buy 1 220 put. So I'm looking to sell that, go far enough out of the money. I think it was a 26 delta here. So there's only a 26% probability we're going to close under 230 in the next 30 days. So we're going to sell 1 230 put, buy 1 220 put. It should be trading somewhere around $1.23 credit. What do you got on that, Joe?
So this is it right here, the April 12, 230. Let's see, that's the put right here on this option level 2. So it was, closed at 166 by 193. The last was 182.
Okay.
And then it's at, you said buy, correct?
Yeah, so I'm going to sell the 230 put, buy the 220 put. So do a put credit spread. I like this. This is very good for somebody trading because you got everything on one screen.
Yeah, you can customize it. This is just a very basic customization that I did to make everything available on one screen, and it's really easy to do. Anyone could do that. Do I have that right?
Yeah,
We're
so you're selling
the 230.
Selling the April 12 230 put and buying the April 12 220 put. And what do you get for a credit on that?
What does that say? 131. Is that right?
It'd be, I mean, it looked like I thought when I was looking at it, maybe $1.23, but closing prices.
Oh yeah, I don't know if it. See, that's one thing that you can customize on the platform. You can have the calculation go off the bid, the ask, or the last. So I'm not sure which
good point.
Yeah, there's a setting in here that allows you to do that, so you can change it so that it goes off of the different price Gosh, I forget where
But
that
that's in
was,
the
but there's a way to do that. So that's, I mean,
yeah.
that's
But
the
that's
difference.
yeah, and that's in the ballpark. So that's folks, that would be the type of trade, and you can see the graph there. And Joe can explain the graph a little bit, where you can see real nice the price is. Where's the current? I think it closed at around 236.
Yep, closed at 236,
Yeah.
38.
Okay.
And this is your graph. Not too familiar with exactly how these, when you move the mouse over the graph, you get
Yeah.
different calculations based on the price. So, like, across the center here, this is the strike price. So based on where the stock is trading, that's where the graph is going to show you. So, here we're at 220, and then all the way out here we're at 230.
Okay. All right. So yeah, this would just be an example of a cash secured put alternative with kind of where Costco closed. Let's see. Torin says, she says the 220 put isn't shown. I just looked at this the last few minutes before it closed. Are you saying it doesn't trade or isn't shown, Torin? But I'm just giving an example here. You would think the 220 put would be trading. But
Well,
anyways.
it's not shown. It's not shown on this chain here. So
I
you
got
can
you.
you can let's see. Yeah,
Depending on how many strikes you want. Okay.
yeah. There's a way to change that. Here we go. It looks like it goes a max of 10, but you can get it so that it shows whatever strikes that you
I
want.
got it. Yeah, and that's
And
a nice thing, Torm. What Joe's saying about the customization, you can, he's saying this is pretty basic, but you can set it up how many strikes you want shown. And what were you going to say, Joe? Go ahead.
The symbol for the SPX is .SPX, so I have that if you wanted to pull that one up.
Oh, good. Maybe we could go back. But yeah, this would be a basic put credit spread, folks, in something you could do in Costco, which, if it's, Joe mentioned it was trading, or at least gave you a price of around $1.30, and the strikes between the 220 strike that I'm buying and the one I'm selling 230 would be 10, so it'd be $1,000 less 130. It'd be $870 margin, versus if you were to just go sell a put, one put, your margin would be over 20-some thousand dollars. So this is a much more efficient way, in my opinion, of skinning the cat when you're doing cash secured puts or other strategies that involve stock. Nothing wrong with stock. I'm just, from an options are a lot cheaper, so you get better yield potential. So anyways,
I see a question.
Joe, anything
in there.
else you want to mention? Oh yeah.
No, I mean, the platform is fairly self-explanatory. They set it up so that it's easy to use and simple. And if anyone has questions or
Yeah.
needs help, we have a support desk here. Give us a call, and someone will get on the phone right away and be able to help them. But I see a question here. Someone asks, when and why do you use a level 2? I just wanted to answer that really quickly. When you're getting into a specific option or a stock, and say it's bid at $5 and it's offered at $5.30, you want to know where to place your trade by looking at the level 2. I mean, do you want to buy it at the bid? Do you want to buy it at the ask? Do you want to buy it somewhere in between? So you would use the prices in the level 2 screen to determine the actual price you're going to send for your order. And Dan, I don't know if you have anything to add as far as options, but that's in general the concept between why you use a level 2 screen.
No, I think you said it perfectly. Yeah. Joe, I thought would you want to do maybe time for one more strategy?
Yeah, sure.
Maybe we could look at different vehicle, look at Amazon. And maybe we could start with a price chart of Amazon.
Okay, so what type of chart? How much? Here's a 5-minute
maybe
chart.
Like
you want a 90-day chart?
90-day is fine. And I think, the one thing that strikes me on some of these stocks mean, you have a little bit of movement lately, but if you look at Amazon, over the last couple months or so, there's been more kind of range bound, right? Which you generally don't think when you think of the FANG stocks, right? For a period of time, if you follow the FANG stocks from September 2018, if you look at this chart from, let's see, if we look at, go back in November and December, that's of November and December of 18, right? And that's anything but trending, right? It was all over the place, right? I mean, it was the FANG stocks were up a lot one day, down a lot the next day.
Yeah, so here this is going back a thousand days here, so you can see what it was doing back then.
Oh yeah, and you could see as we maybe zero in for a second, if we could get maybe just like a 9 month or a year, 9 months or 1 year, just something a little less. I'm trying to get back to like September area when right around when the latest correction. Yeah, perfect. So if you look here, you can see in Amazon starting in September, especially early October, when the market started to correct, right? And, to say these stocks were stable, they were out of control, right? If you look at Amazon, dropping like a rock, then, running up $150, down 150, up, maybe good swing trading or something like that. But if you look, wouldn't you agree? But if you look at November, December, it was kind of all over the place. But if you look at it since maybe January and February, it looks at the unthinkable, doesn't it, Joe? A little more range bound, right? Yeah. A little, and so when a stock is more range bound like that, I might be looking at, like we talked about, an iron condor, and so something that I might look at. Joe, you ready to? You got your fingers ready to type in 4 options?
Sure.
So based on that, more of a range bound strategy, folks. And again, for the first time in a while, some of these FANGs have been a little range bound. And so something I would do in there, I'll just give you an example one so you can get familiar with the software a little bit more. But if we take Amazon, something that has become popular, Joe, over the last few years as we've incorporated weeklies, before when I was trading in the pits in Chicago at the CBOE, you could only trade something close to expiration once a month when it got close to expiration. But these days, you can trade a 7 or 8 day trade every week because they have these short-term weeklies. So I'm looking at a 9-day trade in Amazon, a 9-day iron condor. And again, you can do, if you like shorter-term trades, it can give you a little higher yield, a little more price risk. Here'd be an example of a 9-day trade if we're looking at the March 22 expiration. So if I'm looking at the March 22 expiration, just give you a little example of what an iron condor would look like, folks, on a 9-day trade. And I'm looking to sell the 1770 calls, Joe, and the 1630 puts, and then buying my wings 10 points away. So in the March 22 expiration, I'm looking to sell a 1770 call and a 1630 put, and then buy my hedges 10 points further out of the money on each of them. So the 1780 calls and the 1620 puts. And then I'll just explain real quick to folks how I came up with this thing. But you can at least see what the iron condor.
Can you say that again, the hedges?
Oh, sure. The hedges would be on the call side, the 1780s, 10 points up from the short 1770. And on the put side, it'll be 10 points under our short put of 1630, it'd be 1620. So I'd be selling in the call side, the 1770s, buying the 1780s. And on the put side, selling the 1630 puts buying the 1620s. I know it gets a little bit when you're doing four options here. So we're dealing with the 9 days out. That would be a week from this Friday, March 22 expiration, selling the 1770 calls and buying the 1780s, and then selling the 1630 puts and buying the 1620 puts. I'm just giving an example here. I usually do more in SPX, to be honest with you, but I mean, some of these FANG stocks have had a nice range. And so I like, over the last 2 months, we've been doing a little more of these types of trades. Joe, how you doing there? Let me see how we got. We got the puts, selling the 1630 puts, right? And then buying the 1620 puts. Okay, there's your iron condor.
That's better.
There's the, yeah, good. Yeah. So folks, that would be your typical graph from an iron condor, with the underlying in Amazon being around 1690, 1691. We're selling a call strike at 1770, about 80 points up, and we're selling the 1630 puts about 60 points down. And again, on a 9-day trade, I'm looking to be in it about 20 to 30% of the time. So I'm looking to be in this maybe 2 to 3 days. That's it. And the credit is going for, what do you show, Joe? Something like 220 or something like that? Some type of credit, or maybe lower?
It says
Again,
181.
it depends if you're using, okay, 180, maybe it's, I was looking at mid prices, it was a little bit higher, but that's it, folks. We're looking in this type of trade for it to be between the short strikes. But again, I'm not looking to hold this to expiration. I'm looking to hold it for 2 or 3 days, make 7 or 8%, and get out. And I don't want to lose much more than I made. So that's really a quick way of talking about this. But yeah, I think that might be it. I think I don't know if we're running out of time, but I'm glad we got a chance to see the platform. I like the simplicity of it, and I like the fact that you don't really have to leave the screen, right, Joe? You don't have to leave this.
Right. Yeah. Everything's here.
That's wonderful. Well, the only thing I got to extra say, and then if people have any questions, I was just going to say one quick thing, folks. If you want to hear more of this type of thing, I'll just because we're doing one this week, Friday at 2:00 Central, I'll be doing a free 1-hour webinar at Sheridan Mentoring. If you just go to SheridanMentoring.com, and the front page, you'll see free webinar that I had one scheduled. If you want to just sign up for that, if you can't make it live, we'll send you out a copy of it. But I'll be talking about mastering one trade, the art of mastering one trade, and I'll probably be talking maybe a little bit more about Iron Condor. But if you want to learn more on strategies, I'll be talking about that Friday. Joe, I see we got a few questions here. Do you want to hit? Let's see, from Paul and Torin.
Yeah, sure. So I answered Paul's earlier. Torin wants to know, what about the trade size?
Trade size. Trade size would be, again, I think the principle, I'll use the principle of common sense, right? If you don't have, 30 or 40, if you don't have 10 or 20 credit spreads under your belt that you've done and understand it, 10 or 20 live ones, or 10 or 20 iron condors, and you don't, hey, start with one contract, right? I would start with one contract and do paper. I don't care if you have $2 billion. Start with one contract, paper, understand the strategy, simulate it. Once you understand it, then I would move into one contract live. I would do that for a month or two. Make sure you understand it, right? Make sure you understand execution, and you can get in and out of trades and use the platform and understand risk management. once you build the foundation, then it's easier to increase your size. And then I might go from 1 to 4 or something like that, and then from 4 to 10 or something. But again, it's imperative that you have a 3 or 4 month foundation, that you learn the brokerage platform, and that you understand, and that you can, I want to see you trade an iron condor in, market going up, market going down, and make sure you don't do a Three Stooges. So that's how I would handle that. And again, Galen was asking, the site for the webinar Friday that I'll be doing will be SheridanMentoring.com. Sheridan, SHERIDAN, SheridanMentoring.com. And right on the front page, you'll see free webinar. Just click for Friday, and I'll be going from 2 Central till 3. It'll be an hour, and it'll be recorded. If you can't make it live, just sign up, and we'll send it to you. And I'll be talking about the craft of making one strategy becoming a master craftsman. I'll probably be using iron condors or credit spreads or something like that as an example. So anyways, if anybody has any other questions while Joe and I are here on the platform, or anything that I went over, please type it in. I'm at Dan at SheridanMentoring.com if you have any questions, or email Joe, maybe Joe Kid, if you have any questions. Someone said, can you post the site in the chat room?
I can type it in. Dan, what is it again? It's
yeah, just go to Sheridan Mentoring. Just type in SheridanMentoring.com, and
there you go. That's it, right? SheridanMentoring.com.
Yeah, we made it easy right on the front page. Just click sign up, and we'll send you the video, or you can watch it live on Friday at 2 Central. And anybody else got anything, or Joe, anything else you want to?
No, I don't really have anything further. I just wanted to thank you, Dan, for presenting for us. It's always great to have a knowledgeable options expert teach us what he does to make money. So that's fantastic. Thank you. Everyone else, this webinar is being recorded, and it should be posted to our website within the next week or so. So if you do want to go back and watch a certain section over, or the whole thing over again, it will be posted to our website. And that's all I had. I just want to thank everyone for coming out and participating in the webinar tonight.
All right. Thank you. Thanks, Joe.
Thanks so much, Dan. Everyone have a good night.